Vimeo is the latest company to be spun out of Barry Diller's IAC Interactive, following in the footsteps of dating platform Match Group in July 2020. The online video platform debuted on the Nasdaq under the ticker symbol VMEO. The listing comes on the heels of Vimeo posting 57% sales growth in the first quarter as companies continue to invest in professional video tools during the pandemic. Joining us now is Vimeo CEO Anjali Sud. Anjali, good to see you down there at the Nasdaq. Congrats on the listing. I'm a little bit surprised by the market reaction. You have posted 3 straight quarters of profits. Are you surprised?
Yeah, well, thanks, Brian. It's good to be here. No, honestly, my team and I are very focused on the long term. We are in the early innings of a huge market, helping every business use video. And so, market expectations and volatility is not something that we're worried about. And, it's also true, we didn't raise any capital today. We actually raised money a few months ago, and we're already out at a pretty significant premium to that valuation. So I think, ultimately, it's not about what the market says in the next couple quarters. It's really about building a long-term, enduring business that's going to enable every company of every size to use professional quality video, because today it's not being used, the barriers are too high, and we have the tools and the software and the technology to lower those barriers.
And Anjali, Vimeo is not expected to be, if I'm correct, profitable on an operating basis for the next couple quarters as you invest in the business. What are you investing in?
We're investing in a couple key areas. First and foremost, R&D. Ultimately, the reason most large companies and teams don't use video the same way that they use email or chat or text is because the experience isn't intuitive enough. They're not able to get started creating content and sharing content easily enough. And there's so much we can imagine and build to make that easier. Just last week, we launched a corporate video library, a way for all of your company's video content to be housed in one secure, intuitive, searchable, and cinematic experience. You're going to see us ship more and more features like that. Everything from rethinking webinars and virtual events to helping teams collaborate better. So that's the first area of investment. The other is many people and companies don't actually know that we are a SaaS business. And so we're going to be getting the word out there. You'll see us expand our sales force, both in the US and globally. We're seeing a ton of demand for our products. And so we're trying to get more awareness out there about the offering. And ultimately, look, I think we see this market as we have a tiny sliver today. We have 1.5 million subscribers as against the hundreds of millions of businesses in the world. So as long as we can invest responsibly, as long as our margins continue to improve and we have healthy unit economics, you will see us look to continue to invest to really take share in sort of the life cycle that we're at. So it's a really exciting time for the company. And as a public company now, I think we're really well positioned to take advantage of the opportunity.
Hey, Anjali, it's Julie now here. Who would you be taking share from? Who do you see as your main competitors here? And how do you see taking that share away from them?
Look, the reality is whether you are a small business today or a large company, you're probably not using video in all the ways that you communicate. So it's less that there's an entrenched existing player in the market who we are replacing, and it's much more often, well, I'm not using video. Instead, I'm scheduling a meeting, or I'm hosting an event, or I'm flying someone to a store to train them, or I am, training and onboarding employees using a Google Doc. And we know how immersive and real-time and engaging video is as a medium. It's an incredibly powerful way to get your message across, to share content and knowledge. And so we just want to really help more people do that. And so I would say our biggest competition has historically just been that companies didn't have the sort of inertia to accelerate their digital transformation. That's largely changed since the pandemic. And then most importantly, the tool set and offering wasn't there for companies to adopt. And we are uniquely positioned to change that given our technology and our expertise.
And Anjali, I'm just curious about how you guys have thought about your position within the market as now an independent company. I mean, it's different than a lot of newly public companies. People know the story. People have had visibility into the financials of Vimeo over the last handful of years. But now it's you guys and your team kind of, I guess, flying on your own, if that makes sense. How have you guys thought about that transition, out of the IAC structure and now into a standalone unit?
I think we feel really comfortable and prepared to be an independent public company. We are the 11th company to come out of IAC. We have been, sort of walking the walk for a bit of time. So we feel really well prepared. But more importantly, it's exciting to have our own currency in the public markets. Again, we think this market is huge. We want to be ambitious and aggressive in being a leader and continuing our leadership position. And so you'll see us look at everything from organic growth, inorganic growth, M&A opportunities, and being public helps that. And then lastly, as I mentioned, most people still think of Vimeo as the sort of ad-free alternative to YouTube. They don't realize that we have this software for businesses. And so anything that gives us a platform to better tell our story to potential customers, I think is a very powerful and good thing for the company.
What would interest you, Anjali, in terms of acquisitions?
We've done several acquisitions in the last few years, everything from live streaming technology to AI-based video creation, and we've also integrated all of that into Vimeo's platform. And so we'll always look at M&A opportunities, and it's everything from new technology, institutional knowledge, intellectual property that we don't yet have, as well as incredible teams and talent, as well as ways that we can expand our addressable market by getting into areas that we don't have the ability to do today. And I think under IAC, we've always used M&A as another growth lever, and we'll look to do that opportunistically as it makes sense. Ultimately, what I can tell you, though, is we have all the ingredients today, the technology, the capital, the team, and the vision to grow organically. And ultimately, that's our focus, and really where I think that the rubber hits the road. And I think about us going out as a public company, our biggest focus is building great products, delivering value to our customers over the long term.
And Anjali, we're, for investors trying to understand what you do and your path forward, how will the great reopening of the world economy impact your business?
I think you're going to see a lot of small businesses reopen, which is a good thing for us. A big, substantial percentage of our customer base are these small businesses, many of whom have struggled since the pandemic. And then I think if you look at the enterprise side, where we've had tremendous momentum with the largest of companies from Amazon to Starbucks to Intuit using our tools, I actually think what we're seeing there is a lot of companies are leaning into their digital transformation. As many of them think about their employee bases returning to work, they expect work to be more flexible, and they know that they're going to have more distributed workforces. And the power of video, being able to live stream your town halls, train your employees, use video in your marketing to reach your customers, it becomes more essential than ever. So I expect, it's hard to predict exactly how demand will move on a sort of quarter to quarter basis, but if you just zoom out and look at 2021, 2022 and beyond, we very much expect that video has become part of the new normal, and that our demand for our tools will sort of settle at an elevated place from where it was before the pandemic.
Well, the Yahoo Finance team remembers, Anjali, in 2019, you're in our studios in person, and we were talking about this, and now the day is here. Congrats from our team to yours. We look forward to staying in touch.
Thank you.
But first, I want to get straight to Yahoo Finance's Brian Cheung, who has a exclusive interview here. The Federal Reserve Vice Chair, Richard Clarida, standing by. Brian?
Thanks so much, Zach. Well, yes, joining us here on Yahoo Finance in an exclusive is Vice Chairman of the Federal Reserve Board. That's Richard Clarida. Thank you so much for joining us this afternoon. I wanted to ask you, just kicking things off, we're going to get an interesting print on inflation, that's PCE, on Friday, in addition to a jobs report next Friday. Just curious what your updated outlook is on the economy as we await those very two important data points, at least from the Fed's view.
Well, thank you, and enjoy having a chance to do the show. The outlook for the economy in terms of economic activity is very, very positive. My outlook is for growth somewhere north of 6% this year, possibly 7%. If we get that in GDP, it'd be the fastest 4 quarters of growth in 35 years. Of course, we have to remember the economy was thrust into a very deep hole last year with the pandemic and the mitigation efforts put in place. We have a resilient economy, a lot of policy support, and the vaccines. And so certainly very constructive on economic activity. In terms of the labor market, I think the most recent employment report really highlights a fair amount of near-term uncertainty about the labor market. We're still about 8 million jobs short of where we were 15 months ago. And it may take more time to reopen a $20 trillion economy than it did to shut it down. At the current pace of the last 3 months of 500,000 jobs per month, it would take until August of 2022 to recoup those 8 million jobs. On the inflation outlook, obviously, the CPI number that we got recently was a very unpleasant surprise. We and other forecasters had expected both PCE and CPI inflation to move up on reopening, but that increase certainly caught my and others' attention. Brian, I continue to believe, as my baseline case, that this will prove to be largely transitory, and I think the details of that recent report are consistent with that. But let me also emphasize, we're going to be looking at the data very closely in coming months, and if in the risk case, the upward pressure on inflation were to prove to be more persistent and to put upward pressure on inflation expectations, we have the tools, and I'm convinced that we would act to counteract that and bring inflation down to our long-run goal of 2%.
So I want to elaborate on that point that you just made about the expectation that we may not get a lot of those 8 million jobs, at least compared to pre-pandemic levels, back until August of 2022. Does that imply that that's how long it's going to take before the Fed then starts to pull back on some of the aggressive policy measures that you've put in place since the pandemic?
No, I was merely making the point that if the last 3-month average were to continue, that it would take that amount of time. I myself think that the pace of labor market improvement will pick up. I think that, we have to remember we still have tens of millions of Americans who've not yet been vaccinated. I think we'll have a much better sense. We'll have children returning to school in most of the country. We will have other factors that I think will lead to a pickup in employment as my baseline. We want to make our criteria, as you know, as a seasoned Fed watcher, is that we want to make substantial further progress towards our maximum employment and price stability goals, and we'll be attuned and attentive to the data flow as it's coming in on that.
So you said last week that monetary policy is as much about risk management as it is the baseline. I found that a very interesting commentary because everyone has a different definition for what the biggest risk is going to be. We heard from Larry Summers in an op-ed this morning that he said overheating, not excessive slack, is the biggest risk in his view. Is there a risk that the Fed, with its new reaction function, might have to hit the brakes too abruptly in a way where that risk management could really become an issue for the central bank?
That's a good question. So again, I think, and I like the opportunity because a big important part of policy is risk management. There's a lot of focus on our baseline view, which does not see a persistent threat to our price stability mandate. But of course, there is a risk case. There's also a downside risk case, unfortunately, on the virus and new variants and the fact that the rest of the world's not vaccinated. But focusing now on the upside case, we have enormous pent-up demand in the economy with monetary and fiscal policy support. We also have enormous potential pent-up supply, those 8 million jobs that I talked about. And so it's going to take some time to get a clearer sense of how supply and demand will balance. Now, in the risk case, which Larry and others have focused on, in the risk case where these pressures are more persistent, and they put our price stability mandate at risk, we will recognize that, and through our communication and our tools, I think we will be able to offset that in a way that would be supportive of maintaining economic recovery. So that's the way I'm looking at it.
So if it's not your base case scenario, as I understand it, for that to be the case, we are, however, hearing some commentary that there is some concern that that could be the case. We heard from Philadelphia Fed President Patrick Harker, in addition to Dallas Fed President Robert Kaplan, saying that they would prefer to have discussions at least on tapering, pulling back the quantitative easing program pace sooner rather than later. Do you agree on that point, or is that type of risk threat not quite there, at least in your view right now?
Well, I think the minutes stated well my thinking, and obviously most of the committee. It may well be the time that there will come a time in upcoming meetings we'll be at the point where we can begin discuss scaling back the pace of asset purchases. Obviously, that's not something that was the focus of the April meeting. Again, I think it's going to depend on the flow of data that we get. Also, I think it's important to appreciate the pandemic shock that that shut down the economy last year was really unprecedented, I think, in everyone's lifetime. You'd have to go back to 1918 probably. And shutting down the economy put very substantial downward pressure on prices. CPI inflation, I think, was 1.3 or 4%, and that turned out to be transitory. Reopening the economy is clearly, as we saw in the CPI report, putting some upward pressure on inflation. And so we're doing what statisticians call a signal extraction exercise in a complex period. So we need to be humble. We need to acknowledge there's a risk case on both sides. And I would expect, as the data comes in throughout the rest of the year, we will, as a committee, be able to assess that and communicate what that means for meeting our substantial progress test.
So let's talk a little bit more about communication. We saw markets maybe not go crazy, but they did kind of jitter after the minutes that showed there were some participants that felt that rapid progress is possible, where they might want to start tapering earlier rather than later. Do you feel like markets are getting the message? The Fed has a new reaction function because of the changes to the framework made at Jackson Hole some time ago. You were formerly a Fed watcher for many years before you went to the Fed, so you have interesting perspective on both sides. Are they reading you guys right?
I think so. I think broadly, obviously, we can find days and particular events, but I think broadly our new reaction function has come to be well understood. I think the surveys that the New York Fed conducts will show that. But I think the important point to remember, I think the biggest change is that we're really more outcome-based than outlook-based. So our underlying goals, Brian, have not changed. We want to get to the maximum level of employment consistent with price stability and keep it there. We continue to define price stability as 2% in the long run, so that's not changed. But what we have said is that we want inflation to average 2% over time so as to keep inflation expectations well anchored. And that will allow me to get in a plug for a staff index. The Fed staff has developed an index, which I'm a big fan of. It's called the Index of Common Inflation Expectations. And it's essentially an agnostic statistical approach to extract the common element in more than 20 different indicators of expected inflation. And that index is right around 2%. Right now, it drifted down a bit in the pandemic. It's drifted up, but I would argue that it's very much in a range that's consistent with well-anchored inflation expectations. And we're going to have to keep a close eye on that going forward, certainly. At least I will.
So when it comes to looking at inflation, obviously inflation expectations is a big part of where you might see inflation going in the future. You can look at market-based measures on the TIPS market. You can look at survey-based measures. But it seems like everything, not just inflation, but even employment data, is very noisy right now. So are you holding more water, if you will, in actual realized inflation or inflation expectations?
Well, speaking for myself, yes. In fact, I'm putting a lot of weight on inflation expectations because the historical experience of the last 30 years and macroeconomics indicates that keeping inflation expectations is essential for achieving our price stability goal and actually help us to achieve our maximum employment goal as well. But you are correct. I think there is a signal. There's always signal and noise in data. And unfortunately, we're in a period where the ratio of signal to noise is probably lower than on average, which is why we're looking at a wide range of indicators. I should also say that in the labor market, in addition to looking at indicators of employment and participation and the JOLTS data, for example, job finding data, it's also important to look at data on wages, compensation, productivity as well. In the last cycle, even though the unemployment rate fell to 3.5%, we did not see wage gains that were excessive relative to productivity and our inflation goals. And certainly going forward, that'll be a key thing for us to monitor as well. Right now, that is not the case. Although I would point out that even though this was a very deep shock to the economy, if you look, for example, at the Atlanta Fed wage tracker or the employment cost index, they held up pretty well during the pandemic, which for those workers who kept their job was a good thing. So it's certainly something I'll be looking at quite closely.
So can we talk about financial stability for a little bit? Because it seems like a lot of people are paying attention to inflation and employment, obviously, but financial stability could be a caveat to your reaction as well. A lot of people are watching volatility in cryptocurrency markets as of the last week. We know that bank exposure in that asset class has been heating up a bit in recent times. Is that any of that concern you? We heard from St. Louis Fed President James Bullard here on Yahoo Finance. He said a lot of these cryptocurrencies are worthless. What do you have to say on that space?
Well, obviously there are a number of them, so you don't want to paint with too broad a brush, but I don't view cryptocurrencies as really either a store of value or a medium of exchange. Blockchain technology is a technology which obviously has advantages in particular applications, whether or not it involves crypto. But I don't think of crypto broadly as really either a store of value or a medium of exchange. It may serve a role. It may not, but I don't think of it as really a substitute for money in any way that I would recognize as someone who used to teach money and banking very happily decades ago. So it doesn't meet my definition.
Are there any other financial stability risks? Maybe we saw the Archegos episode. We know that the Fed had that financial stability report where it's watching maybe things outside of the traditional banking system, maybe in a hedge fund space. What's the top thing that you're watching that could be a risk as we continue to have this easy money policy?
Well, one thing that I've really found, a number of things since joining the Fed, is the Fed has in place a very systematic and robust framework for assessing financial stability. There are really four pillars. It looks at vulnerabilities in terms of valuation, in terms of leverage, liquidity, and valuation. And those reports by the staff are released twice a year. The committee also gets briefing on those. So I will just on that point restate what Chair Powell said recently, I believe at his press conference, that we're obviously very attentive and attuned and looking at a broad range of indicators of financial stability, but we think financial stability risks now are manageable.
And then lastly, I just wanted to ask, there's a lot of question about the musical chairs that could be happening within the Federal Reserve Board. Your term on the Fed expires January 2022. Have you had discussions with anyone in the administration about a renomination?
I have not had any such discussions, and I am enjoying being Fed Vice Chair enormously. It's been an enormous privilege to do it, and I'm eager to get as much done as I can in my remaining time in this position.
And I'm sure it'd be very interesting, especially given what everyone has gone through in the last year. But again, Federal Reserve Vice Chairman Richard Clarida joining us here on Yahoo Finance. Thank you so much for joining us.
Thank you.
Welcome back. George Floyd Square. It's the intersection of 38th and Chicago in Minneapolis. It's where George Floyd died and where a global reckoning on racism began.
Yahoo News' Crystal Hill went there to hear from residents and business owners. Once ordinary streets turned into a symbol of the racial crossroads in America. Crystal, tell us about your experience walking in George Floyd Square, and has this murder really impacted the history of this city?
Yeah, I mean, when I first entered the square, I was just struck by how expansive it is. I think the expectation was that there would be, of course, a memorial, a space, with flowers and that's dedicated to Floyd, but it's so much more than just a memorial. The whole area is closed off, and it's sort of become this very sacred space where people come and, sort of pay their respects in a way to Floyd, and not just to Floyd, but to other people who've died, who've been killed by police, such as Breonna Taylor, Philando Castile. It's become this site of mourning, of remembrance, and it's a site that is maintained by the community, that's run by the community. There's really no official, leadership. It's basically community members taking care of the space, deciding what to do with the space. And it's, it's really impacted this intersection that, was once, a very busy intersection that, saw a lot of traffic, and it sort of turned into this closed off space where, cars can't really get through. And, it's become this, very important, space for people who, are advocating for police reform and who are advocating for change.
Crystal, I'm glad you described that it was once this bustling intersection that was filled with vehicular traffic. Right now, there's only pedestrian traffic. Are there plans by local leaders to make this a pedestrian-only formal memorial for George Floyd?
And that's really what is unclear, I think. When I spoke to Councilor Andrea Jenkins, who she is the city council's vice president, and she also represents the area, she sees the space as, as being the site of a racial justice center, or having some kind of center where, the community can really focus on racial justice healing and focus on reform. But activists and people who have been maintaining the square, they want to see it remain a memorial. Some want it to be a memorial permanently. But then others, particularly business owners, want the site to reopen to traffic. They want it to go back to being an intersection, and they think that there's a way to have a memorial there that honors Floyd, while also still, having it be a regular intersection again. As far as what the city wants to do, it's not completely clear if the city is going to reopen it back to traffic, if the city is going to, build some kind of official memorial or keep the memorial there. And so a lot of people, I think, based on conversations I had, are sort of waiting on the city to make an official decision on what they're going to do. There's kind of some uncertainty as far as what it's going to look like moving forward.
Right. Well, Crystal Hill of Yahoo News, thank you for your very important reporting on this story. We know you'll continue to cover that beat for us. Appreciate it. Well, the rapid reopening of the global economy is squeezing manufacturers and choking supply chains around the world as retailers race to restock their shelves and keep up with soaring consumer demand. And that is leading to major bottlenecks at many seaports, including one of the busiest in North America, the Port of Long Beach in Southern California. Joining us now is that port's executive director, Mario Cordero. Mario, it's good to see you. Thanks for being with us. I was reading up that as of just a couple days ago, more than 20 container ships were anchored at that port waiting for entry. What's the situation like now, and has it come down from its peak a few months ago?
Well, it definitely has come down from the peak of a few months ago. So right now, we're hovering around 17, 18 to 22 container vessels at anchor. So things are improving.
So I do want to ask you, Mario, because the last time that we spoke, you said that you anticipated a continuation of a surge throughout the summer, and then that you were expecting more stability from the train taking some of these goods away. Is that timeline still accurate as you see it, or do you think that it might be pushed out a little bit?
It may be pushed out a little bit. I think we are watching, keeping a close eye on the economy. The economy is growing. It's in a very good trajectory in terms of upwards mobility, consumer demand. And of course, as you referenced, it's a historic consumer demand with regard to goods. So query whether or not this may be reduced, because as we are opening up, more people will be spending money on services.
So what does this mean for the average consumer? I mean, I know I had ordered some furniture, and I just keep being told that I'm going to have to wait a little longer because they're having supply chain issues. Are these issues affecting particular sectors coming from particular places, or is it just everything out there is having a problem?
I think it's fair to say that it's affecting all sectors. Obviously, again, for the average American consumer, when we talk about electronics, laptops, appliances, outdoor furniture, and etc. The demand is pretty hefty. And I will say that one of the things that has helped the economy throughout this unfortunate health pandemic we've experienced in the last year or more is the rise of e-commerce. So consumers are now spending money 24/7.
So, Mario, you've said that we need to really have a 24/7 mindset here in the United States. When it comes to your port, especially as you are seeing this backlog grow, is there movement to change the model that you guys are using at the port in Los Angeles to move to that 24/7 model to really ensure these kinds of backlogs and buildups don't continue to happen in the future?
Well, Kristin, that's a great point. And yes, the dialogue with regard to 24/7 operations has elevated. Now, again, this is a vision for a future consideration in terms of the volume that we're receiving. As many are aware, this is the nation's largest container gateway, together with the Port of LA, which is the San Pedro Bay complex. We moved in 2020 an excess of 17 million containers. For 2021, the forecast will be in excess of 18 million containers. There is no other gateway in the United States that even approximates half that number. So as this volume increases, and as Long Beach likes to say, we're the port of choice, we have to have a change of model in terms of how we operate.
Talk to me about President Biden's infrastructure plans. I know he recently, to meet Republicans sort of in the middle, lowered his price tag on that infrastructure plan from 2.3 down to 1.7. What do you hope to get out of that infrastructure plan? And do you have ways that you already know you want to spend the money?
Well, it's welcome news for the administration that when we talk about transportation investment infrastructure, the administration has referenced roads, highways, bridges, and ports. So I think the addition of that conversation to include ports is very welcome news for this industry. As we like to say, international trade is a big component of the economy, and international trade begins at the ports. So for us, there's definitively ways in terms of why we need dire funding across the nation in our important container gateways with regard to the infrastructure that's required for us to remain competitive in the global arena here.
I want to quickly ask you, Mario, we've been talking a lot about the imports and its impact on consumers here. Curious to know how this backlog, these delays right now are actually impacting exports out of the port.
Unfortunately, there is an impact to exports. And the reason is the consumer demand that we have referenced is so high that the international carriers, as soon as that import comes in from Asia, they're trying to mobilize, or they are mobilizing that export, that empty container back to Asia. And the reason is they're getting about 5,600 per container, that for a container that comes from Shanghai to Long Beach, way above the export margin. And that cost has increased over 200% if you go back a year or more.
Mario, what about in terms of manpower? I mean, have you had to hire more people? Are you able to get the skilled work that you need to work the ports and to move these goods in and out of the port in an effective way?
Well, early this year, we did have our challenges, but thanks to the mayor, Robert Garcia, and our governor, Governor Newsom, we were able to mobilize quickly to provide vaccinations to our workforce here for the men and women on the waterfront. So I think today I can represent that the workforce is now full speed. And again, we're doing everything we can to mitigate what we have here in terms of the bottlenecks. But again, the cargo is moving. So I have grounded confidence that we'll continue to improve the movement of the throughput of containers here at this complex.
All right, Mario Cordero, the unsung heroes there, Executive Director of the Port of Long Beach. Thanks to you and your team for helping get those goods to all of us.
Welcome back. Well, many American workers say that they are stressed. So how should they try to manage it? There's perhaps no better person to discuss this with than the pioneer of integrative medicine, Dr. Deepak Chopra, who joins us now. Dr. Chopra, always great to have you here with us. Now, we've had multiple conversations just on this show about how American workers are burned out. They feel like they are languishing. How can they better manage that stress of the last year and some of those just generally blah feelings that so many people have right now?
Well, stress is defined as the perception of threat, either financial threat, which is particularly important on this show, but any kind of threat, emotional threat, psychological threat, physical threat. So right now we have a pandemic of stress in the world, and it's causing inflammation in the body due to something called sympathetic overdrive. That part of your nervous system that perceives danger goes out of whack, in a sense. To counteract that, you can take deep breaths, you can sing, you can chant, you can vocalize, you can focus on empathy, compassion, love, equanimity. But most importantly, meditation is the key. So if anyone closes their eyes, they immediately become aware of what we call the internal dialogue. They're thinking about the future or the past. So they're not present to their own self. Meditation counters this internal dialogue, which is always anticipating the future and regretting the past.
Yeah, I'm guilty as charged, doctor. I'm one of those people. Once my head hits the pillow, my mind starts racing. You know, for those of us who might be new to meditation, might think I can't do that. It seems too hard. What are some baby steps we can take to get us there?
Well, I talk about something called the stop formula, STOP. So whenever you're feeling stressed, anytime, you stop. S, stop. T, take 3 deep breaths and smile from your head to your toes. Do it as a ritual. O, observe your breath or sensation in the body. And P, proceed with compassion and awareness. If even that sounds too complicated, press the pause button and observe your reaction to react before you react. Just that one split second of pause between stimulus and response breaks the cycle of stress. Now, if you want to get deeper, check out 21-Day Meditation with Alicia Keys on the Chopra app, and you'll see all kinds of meditations from 2 minutes to 20 minutes.
So I hear what you're saying about meditation, breaking that cycle of stress. But what if you don't necessarily feel stressed? Is meditation just something that people should incorporate as a part of their everyday daily routine?
That was the original intention by the seers who created meditation. They were not stressed. Living in caves in the Himalayas, they were seeking enlightenment. So the ultimate goal of meditation is to go to the source of thought and access intuition, inspiration, higher consciousness, vision, and ultimately transcendence, to find your true self beyond the mind and beyond the body, what spiritual traditions call the soul.
I know we talk a lot about how our physical well-being is tied to our emotional well-being. How can we use technology? I mean, I know sometimes technology is the source of some of our stress, but how can we use that to help us de-stress our lives, doctor?
I've been doing that with Fitbit recently. So we have meditations on Fitbit, which is an exercise tracker, but also a sleep tracker. And you can instantly check on your Fitbit wristband what your stress level is through electrodermal responses, heart rate variability, breathing, oxygen saturation, and more. And then you can intervene in real time with a breathing technique or a short interrupt or a little bit of reflection or a little bit of mantra practice, and you can see immediately what the effects are. And this is the gift of technology. We're moving from biofeedback to what can only be called bioregulation.
So we're talking a lot about, what people can do on an individual level, really to break that cycle, meditation, practicing mindfulness. I'm curious to know, however, as we're, moving out of this pandemic world, a lot of people are getting ready to go back to work. If there's something that perhaps needs to change within the workplace and the ways that we think about work or manage work, if there's things that employers can do to ensure that their employees aren't always walking around feeling stressed.
This is a very important conversation right now that's happening in the corporate world. What creates corporate well-being? The CEO or whoever is in charge, the leader, has to enlist everybody in shared vision, complement everybody's strengths, create a bond of spiritual and emotional connection, and ensure maximum diversity. And all the data shows that when you have these ingredients, then you have a happy, healthy workplace. If the supervisor ignores his employees or her employees, the rate of disengagement goes up to 40%. On the other hand, if you're criticized, your rate of disengagement goes down to 20%. But if you notice a single strength of an employee, the rate of disengagement goes to less than 1%. This is about $300 billion of economy lost in the United States because the people are unhappy coming to work, and some people are actively disengaged, which means they're not only unhappy, but they come to work to make other people unhappy. I'm involved with a nonprofit called Just Capital, where we actually rate corporations according to what they're doing for their employees. If your employees are happy, then your customers are happy. If your customers are happy, your investors are happy. That creates a good business.
That makes sense. And if you're going to go to work to make other people not happy, do me a favor, just don't come to work. But doctor, as many of us look to going back to the office come the fall or perhaps even sooner, are you hearing that in and of itself is causing some stress as much as we want to get back to normalcy? Is that what you're finding?
Yes, it is something we are finding. At the Chopra Foundation, we have a website called neveralone.love, and we have an AI and a bot that speaks to people, gives them attention, affection, appreciation, and acceptance. And we are actually creating a global network of people offering each other help, resources, and ultimately, I hope, even jobs.
All right. Dr. Deepak Chopra, pioneer of integrative medicine, thanks so much, as always, for joining us. For everyone at home, make sure you try giving meditation a try. I'm going to try it. Alexis, I'm the same with you. I can't meditate very well, so I'm going to have to definitely, I'll have to see if I can do that.
Things are getting more expensive if you're trying to buy a house, and it's 10 consecutive months of accelerating prices. Let's bring in Nobel Prize-winning economist, Professor Robert Schiller. He is professor at Yale University. It's good to have you here. And I just want to start generically, because is this different, this kind of acceleration that we're witnessing, than what we saw in the buildup to the financial collapse of 2008? Should we be worried, and are you?
Yeah, I've been saying I think one should be a little worried. This it looks like 2003 again. If you can see it in this chart. It kept going up. You know, this is not a market that collapses overnight. It's less short-run volatile than the stock market. But you can see that we're seeing price increases now that haven't quite been realized since those years just before the financial crisis.
Well, and how do you explain, I guess, what's going on in the housing market? Is it all because of Fed policy? Is it all because of changes that we're seeing because of COVID? I mean, what exactly do you think are the dynamics at play that are pushing us to see some of the numbers that we've been seeing over the last several months?
Well, of course, the low interest rates are part of it. But I think it's also I've written a book called Narrative Economics, and I think people are driven by narratives. It changes the market sentiment. Market sentiment is a good word. We've had some interesting profits that some people have made. Like we think of Bitcoin, which people thought had collapsed, and then it's back, and then it's trouble again. But these are attracting a kind of general retail crowd who is suddenly interested in market. They have more time on their hands, some of them, because of the coronavirus. They're thinking about repositioning themselves because of recent fears. It doesn't map one-to-one into a clean explanation why the market is doing what it is now. But I think it is some kind of irrational exuberance. People are having fun, and they will as long as prices keep going up.
When we talk about housing prices, though, and I apologize I keep coming back to this, but having lived through that correction that was only within the last 15 years, are we going to have another one of these? Or what worries you about it? And you actually cite the fact that people don't seem to be hedging against the future price increases.
Yeah, there's a certain lability of attention. We tend to pay attention to what other people are paying attention to. So in the housing market, we're paying attention to maybe the demand side. There's also the supply side. You can see that in lumber prices, for example. The builders might be building to profit from these high prices now, but it hasn't happened yet. It will happen eventually, I suppose. We created our futures market at the CME 15 years ago to help builders make more rational decisions. So our futures market is now predicting big increases over the next year or more. But it's not certain, and people have a sense of risk. I wish they used the futures market more than they have been.
So it sounds like even in a year from now, if you're looking to buy a home and you're saying right now it's too crazy, it's too crowded, too many people are looking and they're going too quickly, a year from now, it doesn't sound like you think the situation is going to really improve at all.
There's a lot of momentum in the futures market. There's a little momentum in the stock market. It's talked about a lot, but it's much weaker than the momentum in the housing market. And that weaker momentum eventually carries us into a different situation. So I think that home prices are likely to be higher for another year or two, and they will bring in a supply response, and they'll come back down. Not overnight, but enough to cause some pain.
You just said enough to cause some pain. Is this a bubble? Is this a similar bubble to what we saw in 2006 and 7?
Well, it's not the same. Every bubble is different.
But is this a bubble?
It has aspects of a bubble to it. There's excitement, and people are talking, and some people are bidding way more than the asking price, and that becomes a narrative or a story. So it has a certain amount of excitement in it. It's different though, because I think it's related to the psychology of the coronavirus, which hasn't quite left us. So it's a little bit like in the flu epidemic of 1918. It had a second wave. It didn't disappear until after 1919. But then we had the Roaring '20s. So it kind of reminds me of the spirit that ended after World War II, for example. There was a spending spree by people. They were jubilant. The war is over. They were taking what they call victory vacations. And we're kind of in that mood again as we're coming out of the coronavirus. So it's not the same as 2003. It could be stronger. We have better protections. We have better supervision of lenders. So I don't know if we should be worried about 2007, 8, 9 happening again. But it is disquieting. That's why I think people might want to hedge their housing risk.
When we talk about hedging their housing risk, I mean, looking out across the country, because it's a different scenario playing out in certain areas here of the U.S. When you look at specific regions, the regions that have seen the biggest increase here over the last 12, 14, 16 months, what areas, I guess, concern you the most? Is there a specific area?
Well, the biggest increase over the last year was Phoenix, and home prices have gone up 20% in 1 year. That's a big change. And you see it in San Diego. There's a whole listing of these. The weakest city is Chicago. But even Chicago went up 9% in the last year. These are quite strong numbers. And I would predict they will continue for a while. People have to consider that when they think about making changes in their housing situation.